Hello and welcome to the Opes Wealth Management second quarter 2022 markets discussion. My name is Aaron Whalen, co-president, and with me today, Mark Duval, co-president and chief investment officer, and Louis Odette, senior portfolio manager. To set the stage for today's discussion, it goes without saying it's been a challenging start to the year. First and foremost, the tragedy that we've seen in Ukraine and economic factors that have really impacted all financial asset classes, and consistent with what we were setting the stage for in the last discussion. You made a comment, Louis, in the meeting we had with a client last week about 2021 really being the anomaly and 2022 actually being a more usual year, if you will. Can you elaborate a little bit more on that?
Yeah, absolutely. So, simply put, stock investors should expect a bit of volatility. Right? The straight march up and to the right that we saw last year, that is not normal. So if you look back to 1980, US stocks typically experience a drawdown on average of 14% at some point during the year. This year, we're bang on at 13%, whereas last year we were only at 5%.
So tied to what we've seen, there were some changes, not that we're market timers or had the crystal ball to be clairvoyant enough to know exactly what would happen this quarter, but seeing a little bit of the writing on the wall in terms of potential stresses, we made some changes in the fourth quarter. Could you speak a little bit more and give context around what exactly we did?
Very much so. Based upon how, and to what Louis just said about how much markets had appreciated last year, we went ahead and trimmed back a little bit on large US stocks and replaced that portion with an allocation to alternatives. Alternatives are investments that try to avoid the primary two risks that impact portfolios. On one side, interest rate risk, which as interest rates rise, bond prices get hurt, or stock market volatility, when stock markets can have the potential of going down. And while that move generated capital gains for a lot of clients, and we're having to deal with that today and paying for our taxes, it's actually helped portfolios for that portion by a spread of more than 20%. And so it really was, or has been, beneficial for clients. On top of it, our value bias has been valuable for holding values a little bit better because the biggest place where the stock market has retrenched has been in tech stocks.
So tech stocks are an example of the movement in tech stocks of a lot of the negative headlines we've seen. And I think you could argue that a lot of that's been priced in based upon what we've seen so far year to date, and perhaps some of it not so much. From your perspective, what are the key risk factors that maybe haven't been fully priced in that keep you up at night or that you guys are thinking about?
Yeah, there's two primary risks that we're most concerned about. One of them we've written in the past about geopolitical risk. We didn't know that Russia was going to invade Ukraine. And certainly what's happened there has impacted our markets a little bit thus far. Our concern would be, based upon what eventually happens with that and how it settles out, that could have a negative implication for the markets going forward. The second major risk is one around inflation. Inflation has started out of COVID and supply chain issues, but it's been around long enough and the Federal Reserve really didn't get after it particularly quickly. So now we're seeing the highest inflation that we've seen since 1982. And while the Fed is going to raise rates, what they're trying to do is moderate inflation, moderate the speed of the economy a little bit. It's a tightrope to try and avoid then pushing the US economy into a recession. And that's what they're trying to balance, and that's then the really big threat that's out there. And or if they don't do enough, that we then see enough coming through in wages and see a 70s style wage price spiral.
So thank you for that. Now it's for some potential good news. It's hard to sort of in the headlines, and it's important, of course, that we cover what we see in terms of risks. But let's talk about some potential positive outcomes, things that you're both seeing that lead us to think, actually, this may not be as bad a year as the headlines would lead us to believe.
Mm-hmm. Yeah, so despite a rocky first quarter for stocks, there's still a number of reasons to believe that they could finish this year in positive territory. 4 key points support that view. First of all, The underlying economy remains in pretty good shape. The growth picture is largely intact, and nowhere is that more apparent than in the labor market, where you have more job openings than job seekers. Secondly, because profits and sales have remained fairly steady and stock prices have come down, valuations have become more attractive in the stock market. Thirdly, there's money waiting on the sidelines to potentially buy those stocks. You can see that in both money market fund balances as well as in corporate buybacks. And finally, a word on sentiment. Since falling to the most fearful levels that we've seen since the onset of the COVID pandemic, sentiment has now recovered to more neutral territory, but signs of exuberance are still absent. So for all those reasons, we're a little bit more optimistic on the potential for stocks over the rest of the year. And at the same time, we're preparing our shopping list in case we do see levels become attractive enough to step in.
That's a classic making lemonade out of lemons scenario. Thank you both for sharing your insights. And thank you everyone for joining us today. Many of you, we have meetings coming up in the ensuing weeks, and we'll look forward to seeing you. And for everybody else, please don't hesitate to reach out to us with any questions related to your portfolio or any of the financial factors that come up where we can help and add value. Thank you very much.